Want to dive into trading and make big bucks? Well, hold on to your coffee because it's not as easy as clicking buttons and watching dollar signs roll in. Trading can be like trying to surf a wave, thrilling but treacherous if you don't know what you're doing. Let's break down how not to wipe out while riding the market waves and keep your wallet intact. Number 10. Embrace continuous learning. To become a successful trader, continuous learning is essential as markets constantly evolve due to economic, technological, and regulatory changes. Staying updated on these shifts in 2024 is critical for gaining an edge. New platforms and tools, especially AI and algorithmic trading, require traders to adapt and integrate them into their strategies. Utilizing educational platforms like Coursera and Udemy, and regularly reading financial news from sources like Bloomberg or Reuters ensures informed decisions. Awareness of central bank policies, economic trends, and geopolitical events helps traders navigate market dynamics effectively and stay competitive. Number 9. Understand market basics. Understanding the basics of financial markets is essential before trading. Different markets function uniquely and carry distinct risks and opportunities. The stock market involves trading shares and is influenced by factors like earnings reports, market sentiment, and economic conditions. Forex deals with currency trading, affected by geopolitical events and central bank decisions. Cryptocurrencies are volatile, driven by market sentiment and technology, while commodities are influenced by supply and demand, geopolitical tensions, and natural occurrences. Knowing how these markets work helps you align your trading strategy with your interests and risk tolerance, increasing your chances of success. Number 8. Start with a demo account. The best way to begin your trading journey is by using a demo account. A demo account allows traders to simulate real market conditions without the risk of losing actual money. This is an invaluable tool for beginners who are learning how to execute trades, use trading platforms, and develop their strategies. Many online brokers such as eToro, TD Ameritrade, and Interactive Brokers offer demo accounts where you can practice placing orders, reading charts, and testing different strategies. By practicing with virtual capital, you get a feel for the market's volatility and dynamics without risking your real capital. A demo account also helps you build confidence and understand the intricacies of the platform you're using. Whether you are testing a new strategy or simply familiarizing yourself with trading, the demo account is a critical stepping stone. It is recommended to use demo accounts for a considerable amount of time before moving into live trading. This ensures that you minimize mistakes that could be costly in a real trading environment. Number 7. Develop a trading plan. A trading plan is a detailed blueprint that outlines how, when, and why you will trade. It's one of the most important tools for maintaining discipline and avoiding emotional decision-making. A solid trading plan should include your entry and exit strategies, the types of markets and assets you'll focus on, and your risk management rules. For example, a swing trader who holds positions for several days or weeks might rely heavily on both technical and fundamental analysis, while a day trader would focus more on short-term price movements and intraday volatility. Moreover, a good trading plan also defines your risk tolerance, how much of your capital you are willing to risk on a single trade, typically 1 to 2%. Without a well-defined plan, traders are more likely to act impulsively, often driven by market noise or emotional triggers. This can lead to disastrous results. A plan forces you to stay disciplined, ensuring that every trade aligns with your long-term goals and strategies. Number 6. Choose a trading strategy. Choosing the right trading strategy is crucial for success. The strategy you select will depend on your trading goals, risk tolerance, and the amount of time you can dedicate to trading. There are several strategies to choose from, each with its advantages and challenges. Day trading, for instance, involves buying and selling securities within the same trading day, aiming to profit from short-term price movements. This strategy requires full attention and is more suitable for traders who can spend several hours each day monitoring the markets. Swing trading, on the other hand, involves holding positions for several days or even weeks, allowing traders to capitalize on medium-term price trends. This strategy is ideal for those who may not have the time to monitor the markets constantly but still want to engage in short-term trading. Position trading, a longer-term strategy, involves holding positions for months or even years with trades driven by fundamental analysis. The key is to choose a strategy that fits your lifestyle and goals and stick to it. Number 5. Master risk management. Risk management is the cornerstone of successful trading. Without a solid risk management strategy, even the best trading strategies will eventually lead to losses. The most basic principle of risk management is never to risk more than you can afford to lose. This is typically 1 to 2% of your total trading capital on a single trade. By adhering to this rule, you ensure that a single loss does not wipe out your entire account. Another critical aspect of risk management is the use of stop-loss orders. A stop-loss is a preset order to sell an asset when it reaches a certain price, limiting your losses if the market moves against you. Managing risk also involves position sizing, where you calculate the amount of capital to allocate to each trade based on the asset's volatility and your risk tolerance. Implementing a strong risk management system ensures that you can stay in the game longer and survive losing streaks without significant damage to your portfolio. Number 4. Utilize technical and fundamental analysis. To make informed trading decisions, traders rely on two main types of analysis: technical and fundamental. Technical analysis focuses on historical price movements and patterns using charts and technical indicators such as moving averages, volume, and support and resistance levels. It helps traders identify trends and predict future price movements, which is especially useful for short-term traders like day traders or swing traders. Fundamental analysis, on the other hand, evaluates the intrinsic value of an asset based on financial and economic factors, such as earnings reports, economic data, and industry trends. This type of analysis is more relevant for long-term traders who are looking to invest in assets that are undervalued or have strong growth potential. Combining both technical and fundamental analysis gives traders a comprehensive understanding of the markets, allowing them to make more accurate predictions and execute trades with confidence. Number 3. Practice patience and discipline. One of the biggest challenges in trading is managing emotions. The market's volatility can trigger emotions such as fear, greed, and impatience, leading to impulsive and irrational decisions. Successful traders know the importance of maintaining discipline and sticking to their trading plans, regardless of market conditions. This is where patience comes into play. Not every day will present a good trading opportunity, and trying to force trades often leads to losses. Traders must learn to wait for the right conditions before executing trades. Discipline also means knowing when to cut losses and when to take profits, as per your trading plan. Consistent discipline and patience separate successful traders from those who fail. Number 2. Journal and analyze your trades. Keeping a trading journal is an excellent way to track your progress and identify areas for improvement. Every trade should be documented, including details such as why you entered the trade, what strategy you used, and how the trade turned out. Over time, this journal will help you spot patterns in your trading behavior, highlight mistakes, and refine your strategies. Many traders use tools like Excel or specialized trading journal software to record their trades. Reviewing your journal regularly allows you to evaluate your performance objectively and learn from both your successes and your mistakes. In this way, a trading journal becomes an invaluable tool for long-term improvement and consistency. Number 1. Start small and go live. After months of practicing with a demo account and developing a solid trading plan, the final step is to go live. However, it's important to start small when you begin trading with real money. Even though you may have gained confidence from your demo account experience, trading in a live environment brings new challenges, especially dealing with emotions such as fear and greed. By starting with smaller positions, you minimize your risk and allow yourself time to adjust to the psychological pressure of trading with real money. As you gain more experience and confidence, you can gradually increase your position sizes. The key is to remain patient and focused on building consistency over time, rather than chasing quick profits. The journey to becoming a successful trader in 2024 involves mastering the combination of skills, from continuous learning to disciplined risk management. That's all for today's video. If you're ready to ride the trading wave like a pro, don't forget to hit that like button and subscribe. Stay tuned for more tips and tricks to help you crush it in the markets. Let's grow together, one trade at a time.